Hey, good morning, everyone. I should say good afternoon. Today's webinar I'm really excited about because we'll be talking about mastering the art of investing from like a real global perspective of real estate and also equities. A lot of times people say, hey, which one should I own? And we're going to talk about which one's the best and talk about how you should establish your portfolio. So it's going to be a really fun webinar and a fun debate. My name is Chris Lopez. I'm the guy on there on the left. I'm a real estate investor. I also invest in stocks. I'm an investor-friendly agent. And then I'll be talking about real estate. I got Lon Welsh here, who's one of my mentors and a brilliant real estate investor as well. Glad to have you, Lon.
It's great to be here. Thank you.
And then we got two other guys in the studio. A lot of you know from our previous podcast, Zachary Bouck with Denver Wealth Management. What's up, Zach?
What's up, guys? I got to throw out the hang loose here for our webinar.
I like it. And we got Austyn Garcia also with Denver Wealth Management. How are you, man?
Good. I didn't think of any cool hand gestures.
Sorry,
you got jazz hands.
No pressure.
You have a hard one to follow up there. So for the agenda today is we are going to debate the common question, stocks or bonds. I'm sorry, stocks or real estate. We're talking about identifying your goals. Then we're going to go through a real estate strategy. We'll go through a wealth building strategy. We'll talk about what the best options are in today's market since interest rates are up and the economy is all over the place. All right. I'm going to ask this question out here. I want to see the first person to take the bait. Stocks versus real estate. Which one, Zach?
Do I have to choose the binary question?
Both.
Yeah.
Which one? I can't. I'd be a hypocrite if I picked one over the other. I do both.
Okay.
So I can't vote.
Austyn.
Again, same way. I mean, we talked about it on the podcast, Colorado native. I own Colorado real estate. I own stocks. I own no bonds, but I own traditional assets too. So I can't say which is better. I like both.
All right. Lon, you're going to break the
No, it's
chant
similar. No bonds, but plenty of stock and lots of real estate. So
Yeah.
I think you really should have both.
Yeah, I agree. Like, I just don't, I mean, it's over the years before I really got into investing is a lot of times I talk to like an equities person and, oh, stocks are great. Real estate sucks. You talk to a realtor. Oh, real estate's where that stock sucks. It's not binary. Like,
It's not.
most of the people own both who are very, very successful. And all of us own real estate in Colorado. We all own stocks. And some of us own bonds, apparently. So we've had a couple really fun debates on just market outlooks on the podcast. So make sure you go back and check some of those previous episodes. From a high level, like we could sit here and have some like dramatic 20-minute debate about which one's better and have a very good clickbait discussion. But that's all it is. It's just clickbait. The consensus from everyone I've ever talked to is own both. And then it's figuring out what's the right amount and how to slice and dice that for your portfolio. So I know one of the things that Denver Wealth Management does, and you two host it, is the Millionaire or the Mind of a Millionaire podcast. Give us a quick plug for that, guys. Like, why should people tune in?
Yeah, the podcast started, we've done 130 episodes now, but it started as, so I grew up in North Dakota. I grew up, not a lot of money, one of 7 kids, and I became a financial advisor. And we talked a little bit on that last episode about how that happened. So it doesn't make a lot of sense. So I didn't come from wealth. I didn't know how wealth worked. The Mind of a Millionaire podcast started by me and Austyn. We work with, there's over 800 households at Denver Wealth Management. And we were just taking their lessons and doing a podcast about them. How did you make your money? How did you invest your money? What do you think about the market? How do you think about debt? How do you think about real estate? How do you think about stocks? How do you think about bonds? And the podcast is started as just us kind of like relaying these stories that we learned from our wealthy clients. And it's kind of evolved over the years to become more of a, half of it is content that can help you in like today, like how did the laws change this year when it comes to investing? And then also us kind of talking about the opportunities to invest going forward. So there's definitely been an evolution over the 130 episodes, but we have a lot of fun doing it. Yeah. Anything to add there, Austyn?
Just say it's a lot of fun. My background with Denver Wealth Management, I was a marketing intern. And on my first day, I showed up with a laptop, an old laptop that you could not remove from its power cord and a microphone. And Zach said, I want to start a podcast. So I had to figure out how we were going to do that. And it's evolved from just that one plug-in microphone and a shoddy laptop to a working laptop and a few microphones. And to Zach's point, we do a couple episodes every month. One's technical, one's more behavioral, but at the end of the day, we just have a lot of fun doing it.
Yeah, it's a great podcast. So I definitely recommend people checking it out. And one of the great things about all of us sitting here, we're talking about Denver, talking about wealth. We all live in Denver. Our offices are a couple miles apart near the DTC. We all own real estate. So this is all coming from local investors and local professionals. So please ask us questions. And this is where we live and where we invest. Now, diversification. This is a phrase, a concept I think everyone's familiar with. But we've talked a lot about this in real estate. Like, this is one of the a hard thing to accomplish in real estate. Hey, I own a bunch of rentals here in Denver. I don't have any geographic diversification.
Right.
So you've been investing for like 20 years. How do you balance, how do you view diversification in real estate?
Well, I think a lot of people, they may only have one or two houses, and if they're going to manage themselves, which a lot of people will tend to want to do, which is, I think you're better off getting a property manager so you don't get sucked into it. You have to be close to the property just to be able to check on it. So I think that there's a set of blinders with a lot of newer real estate investors, even intermediate investors. They don't think about geographic diversification, as opposed to when someone hires a wealth manager, when they think about stocks, they would never say, I'm going to put it all into Google. Like, well, would you want to get any other stocks too to kind of balance out the risk? Like, well, I think everybody would say that makes a lot of sense. I don't know why that doesn't extrapolate over to real estate like it should. Well,
I think it's just harder. Like, I can take $100,000, give it to you guys, and you can invest in a couple of different funds or, companies. $100,000 out here in Denver gets
get a broad index fund and you get exposure to everything, but $100,000 in Denver gets you one rental house, and it doesn't diversify very far.
Sometimes half a rental.
Half a rental.
Right,
the way prices are going. Yeah. Exactly.
So, diversification, I feel like this is a very common concept on the equity side. I grew up diversify. What are any updates on what I learned 20 years ago in college for diversification on equities?
Yeah, well, there's two things to think about. I always loved these Warren Buffett quotes, even when they kind of go against what I believe. It's always good to bring in the different ideas. Warren Buffett once said, diversification means you don't know what you're doing. And I always thought that always makes me laugh because, his idea is that if you do all your homework and you put in all the energy and all the effort, you should be able to just buy one perfect, building or one perfect stock and just put all your eggs into that basket. And I like that quote because it kind of forces you to think about why do I want to diversify? And the answer for me, because I do believe in diversification, is that I only have one life to live. So let's say I put all my eggs in one basket and I just blow it. I did all the homework, I did all the research, and then a sinkhole opens up under my building, or the stock is Enron and it goes to zero because there was a scheme that no one could have figured out.
Right.
You put all your eggs in one basket, there's the potential for massive upside, but there's also the potential for massive downside. So I think for a business, it's a little bit of a different risk tolerance than an individual. Because if I turn my net worth and investments to zero, my kids can't go to college and I don't have a home and can't pay for health insurance. There's personal consequences.
It matters.
Yeah, that matters. So that's why I believe in diversification, is because it doesn't just reduce your risk across investments. It reduces your life risk. Blowing up your life.
Yeah. And so, this is a very just core principle to keep in mind, is always diversify. And we'll talk a little about this in real estate because, as Lon said, it's very hard to diversify. So we'll talk about some options on what people are doing and also different layers of diversification as well. So, all this comes down. We talk about invest in this, buy this, do this, or what strategy should I do? But it always comes down to your goals. And Zach and Austyn, you guys meet all the time with new clients. How do you do your goal setting process with your clients?
We've got a little bit. It kind of depends. That's going to be, unfortunately, the answer to a lot of our questions today is it depends, because my goals are different from Zach's goals, are different from both of your goals. So the way that you go about investing or asset allocation, or whether you want to invest in real estate, whether that's physical real estate or REITs, or whether you want to invest in stocks or bonds, it just depends on what your goals are. Now, it's a little bit hard to conceptualize goals that are 20, 30, 40 years down the road.
Yep.
And I think that too often prevents investors from taking action today. So I've been focusing more on, what are you going to regret by not taking action today? What are you going to regret in 20 or 30 years by not investing in retirement, by not investing in property? And how do we address that today? So goals are great. Objectives are great to have, but let's take a more short-term approach to what can we do today to take action to make sure we're fulfilling, our future selves and those future objectives.
Love that question.
Thanks.
Yeah, I would say the thing that I always start, in a new meeting with clients, I always talk about the three things that drive long-term happiness and satisfaction in someone's life are the people that they're around, the place that they live, and if they have purpose in their life. If you have those three components, that generally makes a happy life in 2023 in America. So a lot of the goals that I help people with initially when we're doing this wealth management process is let's make sure those three things are being fulfilled. if you live in I've lived in bad neighborhoods in my life. Like I've lived in Capitol Hill and Park Hill, and both times on the downtrend in Denver. That does not contribute to the quality of your life. So that person's goal might not be retirement at all. It might be, let's get your family out of this horrible neighborhood into a good neighborhood. No shade on Park Hill to our Park Hill listeners.
That's a great area now.
Yeah, when I lived there, I've been here for a while, and it wasn't great when I lived there. Yeah. But that's how we start with goals: is how does this contribute to the happiness of your life?
Yeah, I think that's so important, because if like the client or the investor doesn't know where they want to go, the team can help them get there. It's like, oh, you don't know where you want to go? Okay, how am I supposed to help advise you or help you invest your money to get there? Like, we don't know. So I've always learned that no matter what these strategies you hear, what you hear on CNBC or what you hear on a podcast, always come back to your North Star, which is what your goals and what you want. And I love the 3 Ps you have. Yeah.
And then sort of balance out, are the goals realistic? I've had all these investors say, I've got 100 grand of cash and I need 50,000 a year of passive income. Like, well, me too, but I don't know how to make that happen.
Yeah. Well, yeah, there's your reality check on there as well. We all want the unicorn, right? Now, here's where this has been like an interesting evolution for me as I've talked to a bunch of clients. I'm curious about your perspective on this as too, Lons. People say, I want this, I want this, I want this. And it's like, great. Now let's quantify that. Right. Let's kind of get a rough number and a rough timeline. And I went through a hard time calculating that for myself. I know as clients have done it as well. But in terms of real estate, 80% of the people tell me they want $10,000 a month.
I know.
Passive income. Is that what you hear as well?
I do hear that a lot.
Yeah.
It's like whenever you hire a new real estate agent, I used to own a brokerage. I still run the brokerage, but how much do you want to make in your first year? 100 grand. It's like, they're scripted somehow. Everybody says the exact same amount.
Yep.
Or how much do you want to have in retirement? I'll hear like 200 or 400,000 a year. And like, well, how much do you make now? 150. Do you live a good lifestyle now at 150? Yes. Well, then what do you need like to make 400 for? Like, your house is going to be paid for. You'll pay for your daughter's wedding. All your kids will be out of college. Like, well, you probably won't need more money in retirement than you need before. I usually will ask them, and you guys probably like a way better answer than I do on this, is like, spend some time with your spouse for a couple hours thinking about what is it you want to do in retirement. I want to go on this cruise and that cruise every year. Great. What would that cost? 20,000 and 10,000. And what else do you need to have? And add it up. And like, how much is it? 130 grand. Great. Let's build a portfolio to get you 130 grand. Something realistic. Because if you need to make 400, if you think you need to make 400, you need to have a portfolio that's like so much larger. It's going to be like a lot more work and a lot more sacrifice and a lot more risk, and not very good odds of success.
Yep.
Yeah, I have a theoretical time machine, which now I'm going to add your question to my time machine. But I'll always tell clients, like, well, okay, your goal is 10,000 a month, or 2 cruises is a good example. Let's put you in that time machine. You're 65, you're a little wrinkly, your life has changed. How do you feel when you go on those 2 cruises a year? Okay, so from March 1st to March 15th, you're on a cruise. And then you get back. What does the rest of your life look like? Was that fulfilling to you? Was that satisfying? Are you, and you just try and put them there. But you have a really good question that I've not asked people, which is that you're 65, you always wanted to, start a business, and now you didn't. Like, how do you feel at that point in your life? Like,
like the regret question.
The regret question that Austyn brought up is like, if you can try and like put yourself forward and think back how you might feel, that's very powerful for people.
I love it.
Yeah. Most people don't ever do
the
that.
Fear of loss, I think, is the biggest human motivator, more than the attraction of trying to achieve a gain. And you've really come up with posing the question the right way.
Oh, absolutely. There are studies that'll show, and this is kind of unfortunate, but when you invest for 20 or 30 years, the reality of investing in the long-term stock market is not sexy, but earning a 10% annualized rate of return is great. It works. When you get there, though, people tend to be a little bit like, okay, we're here now. Now what? And so to your point, Juan, it's absolutely correct that in all of those years when the stock market's going up and down, all of that volatility, investors would rather protect their downside rather than see that long-term, somewhat gray upside in the long run. So it's an interesting question, but it also points out your point, which is how much do you really need? Do you really want to seek 16% on an annualized basis and take on all of that volatility and feel the market when it's down by 30% like it was last year? Or do you want to seek 7%, 8%, have a more steady ride and
smooth and steady?
Yeah, exactly.
Yeah. So, in real estate, we usually think in like cash flow. I think monthly cash flow is the most common thing we hear about. And as we were preparing for these slides, I was, hey, what's the common goals we hear? And $10,000 a month is it for real estate? And I don't have, for myself as an investor, I don't have as clear goals on my equities portfolio as I do my real estate side. So it's very clear on real estate, I want X amount of dollars per month. Now, I said, hey, I want $10,000 a month in stocks and equities as well. And then you guys came back and said, no, let's focus on the 4% safe withdrawal rate. First off, what is that? And why do you focus on
This is going to be great.
Yeah. Do you want to get?
No, you can go ahead.
I got it. 4% rule is a really easy rule to help think about how much your assets can produce in retirement income. So if you have $1 million in your bucket of real estate assets, you can very comfortably pull 4% a year out of that bucket. So on $1 million, that's $40,000 a year. And that's just a good rough math estimate for how much income you can pull off. It's a good one to keep in the back of your mind when you look at your assets. Hey, could I retire today? Yes, if you can live off of 4% of your stock market assets. Now, a lot of people ask us, well, Austyn just mentioned that the stock market's historical return is 10 to 12% a year. Why would I only pull out 4% a year? Well, there's two reasons for that. The first is it doesn't return 10 to 12% every year. Last year, for example, the stock market was down 20%. Well, the S&P was. If you take out 10% last year, it's going to very much degrade your asset base. So this year, your 10% withdrawal would be substantially less. And that's the main thing, is that you have to be, if you take out your earnings every year, you can't really get through the down years. And I had a second thing, and it escaped my brain. Oh, inflation. Yeah.
Got to reinvest that.
The thing I was thinking about is most people want to leave an inheritance to somebody.
Yeah, there's that too.
And if you pull out your 10% a year, you're going to just see your account degrade over time. So if you want to make sure there's an inheritance for the next generation or for a charity or somebody that you care about, if you only pull out 4% a year, it's going to leave that asset base. It's like never killing the goose that lays the golden egg.
Right.
Is 4%.
And you may want 100,000 this year, but you might need 104,000 next year because of inflation, 108 and change the year after that. So by leaving a little in there, you can increase it over time.
So I'm pulling out my fancy iPhone calculator here. So if I want $10,000 a month for my stocks and equities with you guys. So if I take 120, divide by 0.04, that means I need $3 million in stocks to say withdraw 4%.
Yep.
And most likely not run out of money.
That is the exact calculation that got me started into looking into real estate, because I wanted to make a couple $100,000 a year, and I backsolved it. The stock portfolio, when I was doing this 25 years ago, it was like $8 million. I'm like, how am I ever going to save up $8 million after tax? Like, is there another way to do this? I started looking into real estate.
So again, this is where it becomes very clear. Understand what your goals are, and then get that vision, and then work backwards to what type of cash flow you need. And as I'm pointing out, be realistic.
Yeah.
Like if you have $100,000 a year now, you probably don't need a $500,000 retirement in 20 years. Now, as we move into the real estate discussion on here, as I talk about my real estate clients, I focus on like 3 concentric circles. And I say our goal is to find the overlap or the sweet spot in these 3 things. Hey, what is the market giving us? Because we cannot change the market. We can't change the real estate market, and we can't change the stock market. So that is just the market gives what the market does. And then there's a strategy. So the strategy could be a long-term rental. It could be Airbnb. It could be go in there and build a house. Could be in there do a value add. There's all sorts of investing strategies. And then there's your goals and your situation, which is, hey, what do you want to achieve? How much money do you have? What resources and skills do you have? And while all of us have different investing strategies, the right type of property for us is all probably different. And it is a very fluid thing. We were talking about this before where, I have 2 young kids, and I think Lon just had his last kid leave the house last year, right?
Yay. Yep.
Yeah. So just very different phases in our life right now.
Right.
Lon probably has more time than I do. And
I
probably
sleep
sleeps more. Yeah. But this is where it comes down to when we look at real estate, like we have people coming, I want to buy like a 10% cap rate property in Denver, which is a really, really, really good property in Denver.
Sign me up.
And we've been seeing those for many years. So it's like, great. Well, I get you want this in your goal. I get you want this in the strategy, but the market is not going to bear this to you.
Right.
So I'm going to give you that news now and not waste 3 years of us trying to find this mythical deal. So keep this in mind as we talk in real estate. And even if you never work with any of us on here, just put this in the way of the back of your mind and keep it in there, because it's a really good roadmap to help you stay on track to reach your goals. All right, so I think a really good story I want to highlight is actually my first rental, because talking with a lot of our clients, reading a lot of the feedback we've gotten on the opt-in form from the webinar was a lot of people who bought rentals and now they're trying to figure out what to do with them. And my first rental property, before I was a real investor, before I was a real estate agent, was just, hey, things are so cheap, I should buy something. I need to buy something. And then my education started. So rewind about 12 years ago now, in 2011, I bought my first condo, a 2-bedroom, 2-bath condo for $67,000. So bought it about the cheapest time in the market. The only time ever timed the market well was with that one purchase I did. And a couple years before it was like 200,000 plus in the boom times.
Where was this condo?
Reno. So Reno, Nevada. But condos in Denver were selling for this price too,
Yeah, same.
12 years ago. So all the same stories here.
Oh my gosh, yeah.
Go back in time, right?
Yeah, but I have a
Hop in Zach's time machine here.
I have a 1-bed, 1-bath condo, and it's not even close to that. And it hurts my heart.
And my mind says like, wow, this is such a bargain. I'm just going to pay it off, enjoy the cash flow. Actually, I'm going to do the
that was a good
thing.
strategy then, actually.
Yeah. But I was going to put on a 15-year note to even do it faster.
Right.
Which is what a lot of us learn, right?
Yeah.
Was that your first inclination with real estate, Lon? Buy something and pay it off?
Yeah, that's what I started with. And then as I learned more, I got better and better ideas. But, you evolve over time.
Yeah, and that's exactly it. And that's where a lot of clients, they were smart enough to take action, buy property, but fast forward 10 years, the market changes and the performance changes. So what I did here was, this was a snapshot of the property when I sold it in 2016 or 17. I was making just under $5,000 a year in cash flow, with expenses minus mortgage. And that's how a lot of people think is, okay, I'm making this amount of money now. But when I'm thinking about retirement, my $10,000 a year goal is great. I'm going to pay off these properties. What's my cash flow? Well, this property paid off was like $8,500 to $10,000 a year. Yeah, no mortgage.
So you'd have to have 12 of these.
Yep. So have that. And that's my next slide. I actually did the math. I was like, oh, crap.
14, okay.
I have a problem here.
14.2.
Yeah. I cannot afford 13.2 condos in here because I want $10,000 a month and a paid off condo is about $700 a month. Well, now I need 14.2 of these guys. And I could not fathom how I would buy these places, especially at higher prices today.
Yep.
And I didn't have $750,000 in cash that day to buy the properties.
Right.
So I was like, oh man, what am I going to do? And it put me into like a little bit of a rough emotional spot. Like I was in a funk for a little bit. And
this isn't fair.
Well, yeah, but I mean, that's what it's reality.
Right.
But I started thinking, you know what? Okay, there's a lot of people out there making a lot of money in real estate. I don't think it's real estate. It's probably something that I'm doing. And I have a little bit of obsessive personality. And after I had this reality check, I just became a student of real estate investing. And like I said, I'm either all in or all out. So I went all in on here. I started a podcast called the Denver Real Estate Investing Podcast to really like learn the market, meet very successful people, and get deals myself. So I just talked to dozens and eventually hundreds of investors and say, hey, what did you do? What didn't you do? What's this? Why did you do this? Why do you do this? And I just learned so much. I sought out mentors, people like Lon Welsh sitting across the table from me. I mean, a big reason I worked at Your Castle and I'm still here is because of Lon and the team Lon's put together, because mentors are just critical in anything. And Zach, we were talking about this before the podcast. We got on some tangent. Why are mentors so important?
Well, I never thought about talking about this in the podcast, but I was a financial advisor for about 5 or 6 years without a real mentor. Like I had a manager at my first firm that I worked at, and he would just, he would mostly like give me very direct feedback and just kind of push me out the door. And I would go get a client, and I learned through trial and error how to work with clients. And then at one point in my career, I think it was 2015, 16, I don't know. We merged with a gentleman named Richard Goblerish, who still works with us. And our business went from like, it just immediately exponentially grew, because what we did is we just stole all the ideas of this guy who had been doing this job for 30 years very successfully. And it was just like jet fuel in our rocket ship here. So if my kids ever came to me and said, hey dad, I want to be in real estate, or I want to be in geology, which is what my son wants to be in, I want to be a geologist. I would just say, okay, go get your education so you know what the heck these guys are talking about. But then go find the most successful person you can possibly find that will talk to you and steal 100% of their ideas.
Yep.
And I wish I would have done that in 2008. I didn't, but I did it in 2016, and it's been just the best thing.
That's great
for our company and our clients too.
Yeah, of course.
And again, that's just another like very, very broad tip there, but that's what I figured. I had the same attitude. Like I said, Lon was one of my huge mentors, still is. And here's the other thing. I just built so many 4-letter word spreadsheets. Like I just built spreadsheet, and all this over a couple of years has a huge compounding effect. And actually, one of the classes I went to with Lon, your 10 myths of real estate investing that you used to teach, is when it clicked with me, it's like, wow, the approach I'm taking I knew was wrong, but now I saw the strategy on how to do it. And I relate this to Monopoly because, I think we all grew up playing Monopoly, all getting the family arguments over Monopoly as well. And it's, hey, buy a greenhouse, buy a greenhouse, buy a greenhouse, buy a greenhouse, then get the red hotel. So very linear and very go around, go 100 times till you save up the money. It's a very hard and slow moving thing to get there. Like using cash to buy more real estate's very, very slow. So what I realized was how to win at real life Monopoly. And I realized, hey, all these people I've learned from, the Lon Welshes out there, all these people, they're not doing this go around, go and do this slow save, slow buy, things like that. They're doing these techniques where they go out there and go from one property and now go to 4 properties. And they're using some more advanced strategies. And this was like one of the biggest epiphanies I've ever had in my investing career. And it just changed the trajectory of my investing and also my career as a real estate agent, helping other people go out there and buy rental properties. So I'll show you some quick math here on how that worked. And when a lot of people come in here and look at properties, like I said, they look at cash flow. Now, on the upper right-hand side, I've got a red box around 157% cash on cash return. I mean, that is a sexy metric, right? Like you put on there, that looks cool. It sounds so good.
And that was your initial cash investment, not the equity that's in it.
No, that's my initial cash investment. And I bought this place.
Which was like a rounding error.
Yeah, and I almost bought this place for $0 down. It's actually like a lot more closer to.
Oh, is this the actual place you bought in Reno?
Yeah.
Oh,
Charlotte Avenue in Reno, Nevada.
Very cool.
So I was like, wow, I got this huge return. And then I was like, wow, but I'm making only a few $1,000s a year in cash flow. And, the percent return doesn't matter to me. I need to be able to pay my bills one day, which is that monthly cash flow. And what I realized from Lon and other people is that, hey, don't just look at cash flow, look at your equity as well. Because for a lot of the people last 10 years, equity is where the market has given us the money back. And so if you look on the left-hand side of that chart there, I had close to $200,000 in equity. And I put 0% down on this property. But if you look at how that rental is performing, I was making about 7.5% return on equity. So all that is saying, hey, all the ways to make money in real estate, cash flow, appreciation, tax benefits, you take all that and divide that over your equity. And I'm making 7.5% on my money. And I saw that and I became a lot less excited. Now, Lon, when you see a 7.5% return on equity, where does your mind go?
Well, you should be able to do something better. So when mortgage rates were cheaper, the easy answer would be to keep the property if it's one that you like, take out as much cash as you can, and then use that money to go buy 3 more properties.
Yep.
But keep what you have. Right now, the mortgage rates are a little bit high, so that's not like the greatest strategy, but everything is cyclical. This won't last forever. We'll go back to lower rates, not as low as they were, but they'll be lower soon. The other option might be is just to sell it and be done with it. So I actually met with an investor this morning, a lot like the example you've got here, where he bought 8 properties over the last 20 years. 6 of the 8 are paid off. He's got tiny balances left on the other 2. I said, which one of these do you like the least? This one. All right, so that one's paid off. So I did the analysis here that you've got. And if we assume 5% appreciation in the market with the cash flow he's getting, he's going to make about 8% per year on this huge slug of equity that he's got in the properties. He doesn't have any mortgage on it at all. And I showed him you could sell the property, pay the commissions, pay the capital gains tax, invest the rest with us. And over the next 5 years, you're going to come $120,000 ahead. And you don't have to manage the property and deal with it. Yep. Which would you rather do? And it was just like, oh, wow, I guess I should do that.
Yeah. And that's such a great point there, is because you always have to look at, hey, how is this money performing today? And people don't look at equity in real estate like that.
They forget about it.
Yeah, they don't realize that in this case,
I don't even think this guy knew that he had $4.5 million worth of equity in these properties until I asked him, put together this little Excel sheet. Like, shit, I didn't know I had like almost $5 million here. Like, you do, you've done really well.
Lon, can I ask you a question? At what point in today's market, March 2023, what return on equity is like acceptable, and what makes you perk up and like look around and say, hey, this is awesome?
Over the last 20 years, my average return on equity has been well over 20%.
Okay.
So something at 15 or higher would be exciting in this market. It's tough to find something on a 20 today.
Just because of mortgage or interest rates?
Well, we've had this really incredible first world problem where the values of properties have skyrocketed, and rents have gone up too, but they haven't gone up as fast. And as the gap gets wider and wider between the property value and the rents, the less cash flow there is. So I'm not sure in Denver that's going to change anytime soon.
Sure.
Yeah. And I mean, one of the things that actually stuck out from that class I went to years ago, Lon, was, hey, if I'm making 7.5% of my money, what's the historical return in the stock market?
Closer to 10, right?
10% a year. And
just sell and put in the stock market, be done with it.
Yeah. Why am I going to take 7.5% and have to deal with tenants, toilets, and liability? Like, for example, not this property, but 2 weeks ago, my property manager, Eric, texted me Sunday morning, which is never a good sign, as anyone with properties.
Guess what? It's Eric.
Yeah, he's like, hey, can you talk? I was like, I can't. I don't want to, Eric. I called him. He's like, yeah.
What's it going to cost me?
Yeah. A burst pipe that flooded while the tenant was out of town for a week.
Of course.
So, that's how it works.
That's the only way that works.
Yeah. So if I'm dealing with that stuff, and the liability and the headaches and all that stuff, I want to make more than the stock market, which is hands off. Hey guys, you take care of this. I don't need to touch it. Give me my annual reports.
Yeah, Fidelity never calls you with questions like that.
No, they don't complain to me about anything, So the whole point here is like, don't just focus on cash flow, but also look at the equity, because the equity a lot of times you can use to reinvest to make more future cash flow. That's the concept here we want to drive home. And so this is what Lon just talked about. This is I'm using air quotes here. This is the great problem. Like the great problem that somebody has had, like, hey, I bought this property for so cheap years ago, so inexpensive, and I'm getting more cash flow, but the market has just been generous saying, hey, here's multiple 6 figures in equity. But if you don't do something with the equity, you don't make money with the equity.
It's just in there sleeping in your account.
Yep. Until you break the piggy bank, you're not going to put it to work. So from what I boiled it down to, there are really 2 main concepts that I learned on going out there to keep going to that 20% plus return in real estate. It was, you want to get more leverage, because real estate's one of the only asset classes where it's really easy to get leverage out there.
A lot of leverage.
Yeah, like it's insane if you don't get leverage.
Yeah.
So leverage always magnifies the return. Now, hey, if it's bad, it's going to make the return worse. I want to put that disclaimer out there. But I think most people believe, hey, in 10 years, prices in Denver, prices in Colorado will be higher.
Yeah.
Rents will be higher. So as long as you have that belief that, hey, prices and rents will be higher in the future, go into with leverage. That was my expectation. The other thing was invest into a better asset class. Now, as Lon said, the last 10 years, Lon was, hey, just sell this rental and then buy another better performing rental. Well, right now, that's still, hey, if you can find a much better performing rental, do it. It's tougher here in Denver, so you might do a different strategy in Denver. You might go down to Pueblo. You might go out of state. You might invest into a business. You might invest into a private equity deal with the real estate. You might invest in the stock market. But find something that could get you more than 7% on your money is the punchline. So what I did here was took a screenshot comparison. That left-hand side is my Reno condo that I sold 5 or 6 years ago. You can see I was making about 7.5% on that return equity. The right-hand side is where I sold that and I bought a 4-plex here in Westminster. So greenhouse to a red hotel, essentially. So 2 things I want to highlight there is that return equity went from 7% to 26%. Exactly what Lon said. 20% plus what we've seen most of the time. But here's the most important thing, because I know return equity gets confusing and percents don't, they don't go in your bank account. But look at my annual net operating income or my future cash flow once the property's paid off. It went from $8,000, which, hey, if anyone here wants to write me an $8,000 check for the rest of my life, please do so. I will cash it, but I want more. This 4-plex is going to be just under $50,000 a year in income from one property. That's almost 5x'd my future retirement cash flow. So what I look at is, hey, great, I have these rental properties. When they're paid off, am I going to get to the cash flow goal that I want to so I can take my cruises, take my trips, pay for this, do this? If it is, great, maybe I just pay off the properties. If it's not going to get me there, well, I need to buy more real estate and maybe reposition some of my real estate. So, Zach, Austyn, you guys got any questions or comments on there?
All I'll add, and this might not be of value, but I did grow up playing Monopoly. And the rules state, so we have a very argumentative household around board games.
Dude, you just made my blood pressure go up like saying that. I'm ready. Let's go.
Let's check the rules here.
Okay, I don't know how you guys play, but if you own 3 or 4 houses and you run out of houses in the box, my family would just borrow them. Like, hey, can I borrow a house? And we'll just put some sort of icon.
Dude, you would lose a finger. You grab one of my houses, you're losing a finger.
You can't do it. Once you run out of green houses in the box, that's it. So one of the strategies to the actual board game of Monopoly is buy all the greenhouses and don't convert them to red hotels. You will raise the blood pressure of your family members or friends who you're playing with.
I've never heard of that.
That's a degree of cutthroat I'd never even thought
about. It's a monopoly.
So,
it's a monopoly on the greenhouses. In real life,
Interesting.
love it.
It's
In
good
the
reason
board
to
game
get
of
those
Monopoly,
light blue and purple ones. You can like gobble them all up quickly.
I'm not playing with you, Austyn.
no one does anymore.
Well, I have a question for you. So, like, I can imagine. Okay, so let's say we did this and we owned our fourplex in Westminster, and now the loan is paid off. But if we look at the paid off return on equity, well, that's less than if we once sold the fourplex in Westminster. Yep. And then, so how do you approach that decision when you get yourself into like you have the fourplex paid off, you have $47,000 a year in net operating income? Would you be compelled to sell that and then leverage up again, or would you be compelled to sit back and say, hey, I did it?
It really depends. So I am not there yet. That property is not paid off, and I doubt if I ever will pay it off. So my main goal that I do for myself, my clients, is, hey, let's just work as fast as possible through leverage and accumulation to go out there and hit that future cash flow, hit the NOI number there. Get to that goal first. Because until you get that goal, it's all hypothetical.
Sure.
And when you get that goal, then debate, hey, should I start paying off some properties? What should I start doing? So go ahead.
Go ahead. So the way I would answer that is the first thing is sit with your spouse and figure out how much do I realistically need to have, and then maybe add 20% on as a cushion, and then figure out what am I going to get from Social Security, from my Roth IRA, my 401k, those distributions, and then there's some sort of a gap that's left over. Say it's $50,000 a year, and that's the gap I've got to figure out some way of filling. So I can either have like an after-tax brokerage account with stocks and bonds to fill the $50,000 gap, or I could have like this property right here to fill the gap. So build a plan, like how many properties do I have to have in conjunction with my stock portfolio to get to that target that I need to be at. And then my question would be, is like, as soon as you can get that number of properties, you can decide either I can say it would be interesting for me to make more money in retirement, but I think for most people that's the wrong answer. Or I could say I'm going to retire now, I'm going to retire earlier, or I could just say I'm going to take the easiest possible path to just like pay this thing off and I'm done.
Sure.
And I think for most people, that's it. I think, we talk about the time value of money all the time. I think there's a time value of time as well. If you can have the option of having a really great quality day when you're 55, I'm 55 anyway, and you're still healthy, you can really enjoy it. That's worth more to me than a really great day when I'm 65. So I might not live that long, or I might not be able to ski when I'm 65 like I can now. So I'd rather see most people have a little less and retire a little sooner so they have more hours to be able to enjoy whatever they've been able to accumulate. So it's a long answer to a short question, but
yeah, I like that phrase though.
That's so well said.
Yeah.
So, like I said, it's kind of probably with your clients. It depends, because when I get here in 10 years, 15 years, 20 years, there's so many
things
factors.
change.
My life, my health, the headaches. Sometimes you love a property. Sometimes you just hate that property.
I'm selling all my active rentals now. I'm just winding down the portfolio, moving it all to passives. I don't need the headache anymore.
Yeah.
Well, rents go up every year too. So even your $47,000 a year,
It's going to grow.
that's just this year. Next year you get 48,000 or whatever.
Yep.
Well, that's also, not to get into like a whole inflation discussion, but I've noticed people go, oh, I don't know what I need in 30 years. Okay, well, in today's dollars,
I know how much I need
to do to get that cruise, because in real estate, we usually keep up with inflation or outpace it.
It'll be close.
Yeah.
Close enough.
As a rule of thumb, like, hey, if you figure out today's numbers, those rents should be the equivalent in future dollars.
Yep.
For a high level, rule of thumb.
I think that's a really good rule of thumb.
So like I said, here's the new reality of this. I went from $8,000 retirement cash flow to about $47,000 in retirement cash flow. So is that extra $40,000 worth it? Well, to me, it is, because I needed to hit my goals. At Lon, at this point, he does not, because he's accumulating more.
I have a big enough portfolio now, so.
Yeah, but he's in a different phase where he's shifting his assets. Like, I'm going to go the much, much easier button.
But what you were doing is what I did for 20 years.
Yeah.
That's why I have a big enough portfolio now.
All right, so what we went through here was kind of the tip of the iceberg when it comes to like analyzing properties. So something that Lon, myself, and our team members do is we are always happy to sit down and look at people's rental portfolios, much like you guys sit down and look at people's, stocks and bonds portfolios. Kind of how you do financial planning on that standpoint. We can do that from a real estate standpoint as well. We're very happy to. We have some cool software called Property Llama. You can plug it in there, helps you get the data. We can help analyze it and help you figure out, hey, what are some right moves and what are some potential moves into your portfolio? And we go through a 5-step process to help you kind of figure out your goals and go through your portfolio, your assets, and figuring out what options you have and come up with a game plan. So if you have any questions on anything real estate related, please reach out to me and Lon. We're happy to help you out, or have one of our team members do as well.
This is a great question right here. We should talk about this.
Yes. Well, Lynn asked, anyone lose properties due to the economy between 2006 and 2010?
I was miserable in 2008 and 9, and I didn't sleep very well, and it was a complete miserable situation. And this is why, even though real estate will tend to have higher returns than stocks, you don't put all your money in stock or all your money in real estate. You probably shouldn't put it all in stocks either. You want to have something outside of real estate so that if you have a disaster like this, you're not like sweating a lot.
Yeah. And where were you? Because you started investing about
98.
98?
Yeah.
So you're about
that's 25 years now.
Okay, so you were 10 years into it.
Yeah.
And so you were actively managing rentals, right?
Well, Eric was helping me out.
Okay.
But I mean, still, like, tenants are leaving and the living place trashed, and we couldn't find a new tenant, and it's just a miserable time.
Ugh.
So these are all problems you don't have with stocks. Like, stocks are easy.
But that's why real estate should make you more money than stocks, because you do
it has to, because it's a big pain.
Yeah.
Yeah. I mean, if you had to put one secret, if you had to say like the secret to investing, it's time frame. If you have the stability to get through, 2008 financial crisis, the COVID thing, whatever is going to happen next, God only knows. If you have the time horizon and you just can put on that like long-term thinking hat, man, you can do better than like 98% of your peers.
You only lose money if you sell.
Yeah.
The stock market's down 30%. Who cares?
I'm not selling my Apple stock or my Home Depot stock. If I don't sell those, I still own my equal percentage of the company.
Yep. Nothing's changed.
So don't sell because of COVID.
Yep.
You'll be fine.
Exactly.
I was 12 in 2008, so I don't have much input there. But it brings up a good point to the.
Thanks for highlighting that, Austyn.
Yeah. Sorry, Lynn. I don't have any input. I was 10 in 2006. But from 1999, the end of 1999 to the end of 2009, that's known as the dead period, or the lost decade, and the S&P 500.
Okay.
So if you invested in the S&P 500 for those 10 years, you earned an annualized negative 0.9%.
Right.
The S&P that we've talked about it today has earned an annualized 10% since its inception. By not diversifying or not having the time horizon like Zach mentioned. It doesn't matter whether you're in stocks, bonds, real estate, or whatnot. Your asset allocation should be diversified to help in certain circumstances like that.
Yeah. All right. So this is, Lon's mentioned this, that he's selling some active rentals and moving to passive real estate investing. And so this is a new concept for a lot of people out there, but, almost just under a year ago, Lon, as you were pivoting from your rentals to doing passive investing, you launched a new business that helps people invest in a passive way. Can you give a executive summary on what Ironton Capital is?
Yeah, I've got a lot of friends that are professionals that are really busy with kids. So they're physicians or architects or attorneys, and they realize they don't want to have all of their savings in stocks and bonds. They'd like to have at least some exposure to investment grade real estate to diversify a bit, but they don't want to go buy a rental and have the headache of doing it. And for whatever reasons, like REITs, real estate investment trusts, aren't right for them. So what we'll do is we'll buy a portfolio of 8 to 12 commercial investments, work hard to diversify it, and then you're getting a tiny slice of each one of them. And our goal is to make somewhere around a 17% annualized return on about a 5-year horizon. Yeah. So the great news is that you're making a lot of money. The bad news is that the money is locked up for 5 years and you can't reach it, as opposed to if you have money at stock fund, like if you need it tomorrow, make a call, the money's there the next morning. So there's pros and cons to everything. The other option we have is a short-term income fund. It pays between 7 and 8%. That's taxed as a REIT, so it's lower tax rate than most things are. And it's pretty liquid, so you can get the money out when you need it. But then the offset is you make half what you would make on the long-term commitment. Yeah. So we have just two different things.
Yeah, and so it's a really good, laws changed about 10 years ago. The market has changed recently. And so for people that own rentals, a lot of times like selling a property and moving it to passive is a very smart play right now, even if you pay capital gains. Mm-hmm. And for all those people that never got into real estate investing because they want to do the hassle of rentals, this is a great option as well. So if you guys want to invest in real estate, definitely check out Ironton Capital and learn about passive investing. All right. So this is, I'm excited to have you guys take control of the microphone and kind of start picking some questions in your brain about how do we look at this from the equity side. So what is your strategy here?
The bucketing strategy. This was a question. I think a lot of people have heard about a bucketing strategy, but it's a really easy way to conceptualize your needs. So as the buckets show, you have one bucket for your living expenses. These are your day-to-day transactions. Just about everyone has a checking account or a savings account. You have your emergency fund, your emergency bucket. Emergencies happen. Last year, I had the uncanny experience of blowing out a tire 3 times within 6 months. So I ran over a nail once, had to get that patch, ran over a nail not a few weeks later, had to get both my back tires replaced. And then ran over some weird U-clip that just completely blew out my back tire. So emergencies happen. And that's the point. And we don't want to take money out of our stocks, our bonds, our real estate. We want to have access to liquidity, to cash. That's the emergency fund. A lot of people start with 1,000. Some people will work up then to 3 to 6 months of expenses.
Yeah. What's your rule of thumb or advice to your clients?
I like 3 to 6 months, but it's a comfortability thing. Once you get over 6 months and you have too much cash, you're losing opportunities and appreciating assets. If you have less than 3 months, then I mean you're a little bit light in our perspective, but it depends. There you go again. It depends.
Yeah, if you have 2 incomes, like husband and wife, they both are contributing to the family. Maybe 3 months is more appropriate. If you've got one breadwinner doing all the work, earning all the money, 6 months is probably more appropriate.
Definitely.
We get people who just, they come in and they say, man, I can't sleep if I don't have 100,000 in the bank. Okay, fine. That's your emergency fund. We'll tell you that, hey, that's too much mathematically, but if you can function in society because you've got that comfortability, I like that word.
I err towards that. I like that a little bit more than I think I need. I sleep well at night.
Me too.
Yeah.
It's not a big deal.
You know why? Because of 2008. So thanks, Lynn, for bringing back all the nightmares.
You got your emergency bucket. Good question. Where are you keeping it? Is it earning interest? Yes. But again, it's comfortability. Some people want all of that in cash to sleep better at night. I don't love to be too heavy in cash, but you still want liquid assets. So you can look to money markets or money market mutual funds that are liquid in a day. There are high yield savings accounts. There are options to keep that money. There's your retirement bucket. We feel very strongly that your retirement bucket is your retirement bucket. That's what you want earning that 10% annualized for decades. You want that to grow. We're not borrowing against it. We're not using that fund besides retirement savings, your 401k, your IRA, Roth IRA, whatever.
And it's amazing how much it grows over 40 years. It's unbelievable.
Awesome.
If you do this math when you're 20, thinking, I'm going to have how much money when I'm 60? And you're like, could that really be true? And then you're like 55, like, shit, it is. Like, unbelievable.
I had a client who I'm from North Dakota, and I'm from a town called Dickinson, and he was from a town called Hebron, and that's like it's like a field with like 4 buildings. That's Hebron, and they make brick. So it's like the brick city. And I went and met with this guy who was like 90. And this was like 10 years ago. And I sit down, he pulls out his Marlboro, starts smoking, asks me if I want one. I said, no,
next time.
It's 2020, don't just smoke cigarettes at the table anymore. And he pulled out his little notepad from like 1950. And he had his first like $5 contribution to the mutual fund.
Oh, I love it.
And then the next month he had like $6, and then he missed a month. He had put in every contribution he ever made to this fund
really?
For like 60 years.
That's awesome.
And it was crazy because because we had to sell it and pay taxes. So that's why we were there. He had to sell it for something else. I mean, this guy had put in like maybe $1,000, and now it was worth like $60,000 over that time frame. And that was probably a really cool experience for me.
That's such a great thing.
Yeah. Never seen a guy smoke more cigarettes in one meeting in my life either. It was just nonstop. It was very exciting.
Well, as Einstein said, compounding interest is the 8th wonder of the world. And the man who understands it collects it, and the guy who doesn't understand it pays it.
Yeah. And I would say with the retirement savings bucket, the reason you want to take the retirement savings bucket seriously, because it's kind of like your fail safe. And I this was really impressed upon me. I started in 2008. My career started August 30th, 2008. So that was a bumpy first year as a financial advisor. But I had this one client who shall remain nameless that he called me every month and said, hey, I need $25,000 for payroll. I need $25,000 for payroll. And he was cashing out his IRA over every month over the course of that 2008 financial crisis. He did that for about 12 months, and eventually his IRA ran out, and then his business closed. So he went from being someone who had a successful business and a successful retirement account
to none.
And so that always impressed upon me is like that retirement bucket. That's like
your
safety bucket.
Don't touch it.
It's sure you have Social Security to fall back on, but I would rather have some of my own money too. So that retirement savings is like a sacred. So
it's very
pact.
sacred.
Yes.
Yeah. And I actually think the first dollars that you have available to save, like there's so many benefits tax-wise to the retirement strategy. Like you should really max those out.
Yeah. Yeah. And it's
you can look at real estate after that.
Yeah. You get the tax deferral of like IRAs and 401ks, or you get tax-free growth of Roth 401ks.
If you can do the Roth, man, that's like the best.
Yeah.
Awesome.
Especially if your employer is matching a few bucks there too.
Yeah.
No, right. It's a great place to start. And then from there, you can only put in, 20,000 ish into the 401k and like 6,000 to 7,000 ish into the IRAs. You know, for high earners, for people who accumulate a lot of wealth, that's where you max out your retirement saving at some point, and that's where we get to what we call the opportunity fund. And I'll kick it back to you, Austyn.
Thanks for teeing that up. The opportunity funds, it's just a lot more fun for me. You conceptualize it as a flex account. It's a flexibility account. I recently read, The Psychology of Money. It's an awesome book. It was written in 2021.
I read that last year.
Yeah. So it's more up to date, but I think so often people think that there has to be a reason to save. You're saving for something. You're saving for retirement. You're saving for a house. You're saving for an emergency. But in reality, there does not have to be that reason to save or reason to invest. And the opportunity fund or the opportunity bucket gives you just that. You have more flexibility in an account like that. So a retirement savings, a 401k, you can't access that money until you're 59 and a half. Let's earn that decades of compound growth. The opportunity fund is not as tax advantageous, but you have access to it whenever you want. So that might be for short-term goals, like the down payment on a home. It might be for buying a boat if you live in a state with water.
Daughter's wedding.
There you go. Wedding. It might be for, again, there just doesn't have to be a reason. So when you look at those latter two buckets, though, I think we got a lot of questions about asset allocation and how to design your investments. Your retirement savings. So you think about a year like 2022, when the market was down 30%. Well, if you don't need your retirement savings for another 30 years, that's fine. 20 years, 10 years, that's okay. You don't want to access that when it's down anyways. The opportunity fund's a little bit different in that maybe you need to access it at some point. Things might come up. So you don't want to take as much risk. That might be more bonds. That might be more, I guess, less risky equities, dividend paying equities, utilities, things like that. Yep. So they're going to be designed a little bit differently. Typically retirement savings, as it's in the accumulation phases, is going to be a little bit more aggressive. The opportunity fund, a little bit less.
Yeah. I like that.
I do too.
All right. Got a question here from Kyle, and this is a great question. Kyle says, with time horizons in mind, how do you think about the risk profile balance of real estate and stocks? We are 33 and have 2 rental properties as well. We're trying to balance the portfolio and where we continue to deploy capital. We have a higher risk appetite in our stock retirement portfolio. Quantify that because that 100% stock allocation. But is an NDF or a nationally diversified fund with iron and capital a better option with less potential upside but more consistent returns? Oh, that is a loaded question there.
No, lots of good questions.
Yeah, that's a really good one.
Do you guys want to start with that? Or?
I'll start with you. First of all, Kyle, good job getting going on buying real estate.
I love it.
Yeah. We have a phrase that we always use for folks who, and obviously I don't know that much about Kyle. So this is pretty generic answer. But we always like to say, you do things from a position of strength. Like that is, if you're going to be investing, especially if you're investing with leverage, which sounds like you are with your rentals, I think. Mm-hmm. You want to start with a position of strength. So you make sure you say he was married. Is that right?
Yeah.
I can't read. I need to go to
married, 33, okay. 2 rentals.
So first you shore up your house's finances. You want to make sure that no matter what happens, you can pay your electric bill and go grocery shopping and fix your tire. If you get 3 flat tires in a year.
All of my tires, yeah.
Yeah. Then you get your emergency fund in order so that if something goes wrong, you get laid off, you get hurt in an accident, you can pay your bills. You make sure you're saving to retirement, like the buckets we talked about, so that if real estate ever blows up, you guys can still retire with dignity. And then you get to that opportunity fund bucket and it's position of strength. If you have the financial strength to do like these higher leverage deals, that's where it's kind of a conversation with, us on this podcast or a financial advisor. Can we stomach the risk of these more intense deals? Do we have the cash flow that if something goes wrong with the deal and we lose our capital, that we're going to still be able to move forward financially? So I would just say it really is that position of strength. I know it's kind of a generic answer, but I don't have so much information about it. But Lon, I'm curious your answer on that as well.
I think what I'd add on to it is that if you look at the stock market over a long period of time, it's around 10% per year. And there's some good years, some bad years. And real estate will have good years and bad years as well. Our goal with NDF 6 is what we're raising for right now, is to do a 17% return. So you can get a higher return 2 ways. You can either take more risk, have more volatility, and you have to get a higher return, but there's also higher risk of a loss. Or you could say, I'm committing not to have access to capital for 5 years. You have to get paid more for that, because if I if you guys could give me 17 in the stock market, I can give you 17, but I can't give you the money back for 5 years. Nobody would possibly invest with me, right? Because they'd always take liquidity versus not. So, if you are absolutely positively sure that you've got enough in your living expense, emergency, and retirement savings bucket, and you still have capital left over, and you have no doubt in your mind that you don't need it for 5 years, you can invest some of that with us, and that'd be a really good choice. But if you're not sure, then we're not a good choice.
Yeah. And it always comes back to diversification. Don't have all your eggs or all your dollars in one basket or one bucket or one investment or one rental property, So, I think I skipped a slide there. There we go. So I actually want to talk about this slide that you guys put in here, Zach and Austyn, and explain this because this goes back to an earlier slide I want to relate it to.
Yeah, this is a real client. I think it's an interesting client as it relates to real estate. He is a person who has slowly been selling off his real estate portfolio over the years and giving us the proceeds every couple of years. He's a very conservative investor, so he's not invested in growth oriented things. But you can see that this chart doesn't look that impressive. But if you look on the left hand side, it's actually in millions, and it's a lot of the times these charts are logarithmic, but this one's linear. So anyway, if you can. But this is our actual reporting software, so you can't mess with it. But, he sold the building in 2014 for about $400,000 and, very conservative over those 5 or 6 years because he's living off his rental income. So we were basically just keeping that money in like treasuries, which if you remember the 2014s were
paying nothing.
Yeah. 2017, he sold another building, put that in his account. He got over $1 million. Treasury started paying us a little more, so we got a little growth. I can't read that number, 2021 or so.
21.
He sold another building, put that in his investment account. Last year, sold another building, put that in his investment account, up over $4.5 million. He's going to sell another building this year. And the buildings he was buying is more akin to like your, what did you call your fourplex? Red roof?
The Red Hotel?
The Red Hotel. Oh,
Monopoly.
I was thinking like the Red Roof Inn. The whole
time. No. I'm still playing Monopoly, man.
I thought it was the name, people name their properties like the estate or whatever.
Right.
I was thinking of that as the name was like the Red Hotel. But.
So I'm not that fancy, nor am I big enough to start naming my properties like that.
You can name your car. Yeah. That's what I do. I name each of my cars. But so this is a guy who had implemented a real estate portfolio over decades and decades. And at a certain point, because of where he was in his life, he decided to start liquidating properties, but also because, he just saw the market being where it was, and with interest rates so low, he thought, man, if people are willing to pay me any price for this building right now,
take it.
So he took it.
Yeah.
And now he's got over $5 million with us. He's got substantial wealth still in real estate, but he was just kind of opportunistically selling off these commercial real estate properties over the years. So anyway, just kind of an interesting story how real estate and wealth managers kind of collide in some situations. So
that's cool.
Yeah.
But I think this is pretty common because I think you said this investors, in his 80s or 90s, just, he's up there in years. But this is pretty common. A lot of people invest in real estate. They work hard, they buy, they accumulate, they go through rough times. And as they, two things, they get older, want to take things easier, and they also get wealthier. They a lot of times transition from real estate to more passive investments, to triple net properties, to stocks or bonds, to passive real estate funds. People want to hit more of the easy button. I mean, it's not just the general criteria.
I think it's a lifestyle
journey of
cycle.
People. Yeah.
Yeah. Everyone's got an investor journey they go through, and eventually you get tired of slaying the dragons every day. And I've got a flood in my property. And if you didn't have a property manager, you'd be the one over there mopping it all up. Wouldn't that be a good time?
I learned very quickly to hire a property manager from day one because I don't want to deal with that stuff. Yeah.
But this is just an interesting example. I thought was most appropriate for this particular webinar, where you can see how just buying real estate and letting it appreciate can also turn into retirement income through the stock market. So,
and you'd asked me a few slides ago, hey, that fourplex I have, when it's paid off in 20 some years, what am I going to do with it? I don't know, but it'll probably be something like this. I'll probably move it to something more passive, and I'll take a little bit less return on there. Yeah. And I'll be fine with that.
Oh, yeah. Send me the checks in Florida on the beach.
Yes. All right. So obviously, if you guys need help with figuring out your equities and bonds and having a wealth manager, connect with Denver Wealth Management. I've spent the last 5 years out here in Denver trying to find financial planners and wealth managers that are great at what they do, but also understand and have appreciation for real estate and say, hey, you know what? These are both great assets to own. These are like the first guys I've met.
It's really rare
So I would highly recommend you guys talk to him. Coincidentally enough, as we've been talking more, we've had a few mutual clients as well, from our investors to some of their clients as well. And all I've heard is good things from our clients with them. So I'm giving you guys a big plug. Check them out, denverwealthmanagement.com, right? You guys got an awesome domain.
Denverwealth.com.
Oh, denverwealth.com.
Make it easier. Management's tough to
spell,
spell.
Yeah.
It's that E at the end.
Yeah. Or scan the QR code, email us. And Lon, you may have to go in a minute here.
I've got another class I've got to run in a second. But
when you have to jet, go for it. But I do want to talk about this for a few minutes. This is our last main point here. I want to debate this. How to build a balanced portfolio. Hey, Lon, thank you so much, man. Nice to meet you. This is great.
Rick, I'm sorry I've got to do the webinar at once.
No, you're good.
Important guy.
So going back to this concept, how to build a balanced portfolio. I mean, what is a magic formula? I don't have one, so I hope you guys brought your crystal ball to tell me 22% here, 38% here, right? You got your crystal ball for me?
Mm-hmm. I don't. Otherwise, I would be doing this from a beach in Costa Rica if I had a crystal ball.
Well,
great.
I'd be there with you.
I think we can. So when it comes to asset allocation, building our portfolios, you can use what's called the efficient market frontier. So it was founded in 1950s by Harry Markowitz, which essentially says that if you look back at these different asset classes, large growth, small growth, international, you can track the performance and volatility over time, and based on the amount of risk that you want to achieve, or the amount of risk that you want to take, or the amount of return that you want to achieve, there's this frontier. It's a neat little curved graph. And at the front of the graph, as you take on a little bit and a little bit more risk, you get a little bit and a little bit more return. But it starts to level off after time, where as you take on significantly more risk, you're not really earning more return. So that's a really good way to start when it comes to building out a portfolio.
What was this called?
Efficient market theory, or the efficient market frontier shows you. So there's a really good question. How can the 4% rule be utilized if you have a mix of real estate and stocks and whatnot for calculating your FIRE number? And I won't go directly into the question, but if you want to earn, say, 7%, like we talked about earlier in the market, 7% gives you that 4% safe withdrawal rate. And then it gives you an additional 3% to keep up with inflation over time and hopefully grow your portfolio a little bit, whether you want to leave it to your estate or perhaps you have higher expenses in retirement, and especially if you're retiring early. Well, we can look back through these different asset allocations and say, well, to earn 7%, we only have to take X amount of risk in the stock market. If you want to earn 10%, you have to take on more risk in the stock market.
I follow.
And that's going to be more defined by the types of assets that you're invested in. So I guess when it comes to balancing your portfolio, again, a lot of it depends on what do you need? What do you need to accomplish? And then we can work backwards from there to build a portfolio based on asset allocation.
Yeah, when you're building a balanced portfolio, and I'm cognizant of time here, so I'm going to keep this short and sweet, is the human nature is very much to buy the thing that is doing well. So like if you look at the stock market in 2021, was that COVID year? Software as a service, that's all the stocks went up parabolic, hundreds, 200, 300% a year. So when you start the next year, where do you look for growth? Well, just human nature is that we look at what grew a lot in the past, and now we want to buy more of that.
Go buy more Zoom stock.
Yeah, more Zoom. I know. And Zoom's a perfect one to talk about, actually, because I won't. I can talk about Zoom stock all day because we all live on die on Zoom, but the stock has gone down for 2 years. The hard part about building a balanced portfolio is being willing to buy the thing that did poorly last year. So actually in 2023, what did poorly last year? Anything that said growth in it, technology, small cap growth, mid-sized company growth, anything that was a growth oriented company got slaughtered. Zoom went from $400 a share now to $70
tech got killed.
Share. So what does everyone think? Well, shoot, what did well last year? These stodgy old boring companies that do mining and stuff. Let's go buy more mining companies. Well, maybe those will do well, maybe they won't. But what I know for sure is that the companies that lost 30% last year are 30% cheaper than they were a year ago. So that's probably the first place to start. And it's lonely being a value-oriented investor because you're going to be wrong a lot in the short term, but in the long term, you'll very often be rewarded for it. So balance comes in a couple different directions. One, like Austyn was saying, was in picking the investments you buy. And then the second place you want to find balance is buying the thing that not a lot of other people love at the moment.
Yeah. And I agree. And that goes back to, I'll probably butcher this Warren Buffett quote, but be fearful when others are greedy, and greedy when others are fearful, I believe, which kind of goes towards that where, hey, these stocks, these assets got hammered last year, and majority of them just got hammered. Now, if they're a bad business, hey, try not to buy those. But just because they're hammered, other people are afraid, hey, you get things on a little bit of discount. Buy it.
Staying on the Warren Buffett train, absolutely. He talks a lot about hamburgers and uses hamburgers for his analogies, which I love. But the Warren Buffett household, he's known to be a beef eater, likes eating steaks, likes eating hamburgers.
Oh, yeah.
And he says when the cost of hamburgers goes down, the Buffett family rejoices. You can buy more hamburgers. But when the price of hamburgers starts to go up, you feel sad. And it's the same with cars. Zach, I asked you on the podcast yesterday, if you're going to buy a car, would you rather buy it when the price is going up or would you rather buy it when the price is going down? I mean, I think we all know the answer. You'd rather buy it while it's cheaper. But it's different when folks look at the stock market, and behaviorally, when the market starts to go down, people get nervous. It's challenging. But if you equate it to any other product or service that you buy, as prices go down, you want to buy. You want to be happy. You want to scoop them up while they're at the bottom. And as prices climb, you don't want to purchase things while they get more expensive.
Yeah, that's such you put that, I liked how you separate out like the investments versus like, more consumer goods. Cause you're right. Never thought about that standpoint, but you're right. So I want to dive in this question a little bit more here with, I think it's Stasik. He says, how can the 4% safe withdrawal rate be utilized if you have a mix of real estate and stocks in context of calculating your FIRE number, so your financial independence retire early number? Could this be used to figure out what point you can start deleveraging your real estate and reduce risk profile from retirement? I can tell you how I look at it. I don't know if it's the right way to do it, but I keep them pretty separate. Like in real estate, I'm very much focused on what my future cash flow is, which is that NOI number. I'm like, okay, I want $20,000 a month, and my personal goal is $20,000 a month in rental income. So I'm all about until I get to $20,000 a month in NOI. And with my real estate, I do nothing with the safe withdrawal rate because it doesn't really work that way. It's cash flow. I can't sell a part of my fourplex. Now on the stock side, I use the 4% safe withdrawal rate. So I say, hey, I want, in my case, I want $20,000 a month NOI in real estate. How do I get that? And in real estate, I want $10,000 a month. How do I get that? And I work backwards to, I need I think a $3 million portfolio for that. So for me, safe withdrawal rate's only stocks, and I look at future cash flow or NOI for real estate. Do you guys have any
I would look at
words of wisdom on there?
No, it seems like in this situation, the simple answer is the right one. I don't think that's a very complicated question, which is good. I think you nailed it, Chris. I don't know.
And the fact that you're buying both, good. And then the other point, hey, when could you start deleveraging your real estate? To me, like I said, I like to live my life by rules. I research, I study, then I try to have a very rule-based life to take out emotion. And then I can just, hey, this happens, my emotions are out, and I just follow a plan. Like, hey, I actually enjoy buying in the stock market now as it goes down. Like, I enjoy that now. 12 years ago, oh my gosh, I would have, a panic attack. So from my perspective, what I do is I'm going to accumulate real estate till hit that $20,000 NOI goal. Then I'm going to reevaluate. And I'll probably go from being very aggressive, like Kyle was saying earlier, being very aggressive buying real estate. Now I'll probably move that over to more of a moderate aggressive. And I'll probably sell or one or two kind of like my loser dog properties, like the ones that flooded. This is a pain in the butt. Get rid of this property. And then I'll probably start readjusting some better long-term assets and move more into less of an aggressive accumulation mode and probably start moving more to like a debt pay down mode of like Dave Ramsey's debt snowball. Hey, pick the property with the highest rate or lowest balance and just kind of take all the excess cash flow and throw it towards that. So right now, that is my plan. Check back with me in like 10 years. I'll give you an update. But right now, that is my plan. So, bottom line here is, I know this is a very unique webinar we did here, talking real estate investing and talking financial planning, which I love. The two podcasts that we've done with you guys, I really enjoyed the debates, discussions we've had, and also we got some like really cool feedback from people. So I know this topic is one that a lot of people want to know about, and many people don't talk about both. So I hope we gave you a good idea. It's like some very high level key points, kind of give you like the high level goal fronts to work towards. But most importantly, please take action. Go out there and talk with your team. If you don't have a team, come talk to me and Lon for real estate. Come talk to Zach and Austyn for your wealth management. Like, start getting your team together, get your goals, and start working with your professionals and your team to say, hey, here's where I need to go. Here's where I'm at. How can I get there? And then get your team and put together an action plan or maybe a financial plan, right? That would be the highlight of this, is go out there and take action. This is where we want to go from concepts to making sure it works for you to get to your goals.
I agree. Yeah. It's all about taking action. It's great. I mean, buying real estate, buying equities, buying bonds, you're buying appreciating assets. That's the bottom line. And I think that's what we talk about quite a bit, is if you are going to buy appreciating assets. But more importantly, don't wait. Take action. Buy. We talked about it in our podcast just yesterday. We don't love cash right now. There's so many better opportunities, whether that's in real estate, whether that's in high yielding fixed income right now, which we haven't seen in a decade, or it's equities, and buy for the long term.
Yep.
Yeah. And my parting thought will be, is our economic system is called capitalism, right? What's the first half of the word of capitalism? It's capital. So it's weird in our society. We're all kind of like trained to go out there and use our labor to generate income. Well, you can use your labor to generate income, but what happens to your ability to do labor over time? Well, it goes up because you get better and smarter at your job, but then it goes down because you start to age. So what you have to be doing while you're able to do labor is you have to start accumulating capital. And that's what, one of the reasons real estate's good is because you can use leverage. It's the only way, you can't get $1 million loan to buy a stock, but you can get $1 million loan to buy real estate. But you can simply, so you got to find a way to get capital. Charlie Munger has a great quote about it. I don't want to say it because it's a swear word, but he's going to say the first $100,000 is really hard to get. And that should be the mission of everybody who wants to go from a laborer to a capitalist, is how do you get that first $100,000? And it's hard. And, Chris and Austyn and Zach, that's what we do, is we not only help people get that, but then we help them grow that. So yeah. It's a lot of work, but it's worth it once you get through that first painful phase.
I love it, guys. This was a fun webinar. Look forward to doing more content, more education from you guys. This is fun. Love the questions from the audience. So Austyn, Zach, thank you guys. Everyone out there in the webinar, thank you so much. This was great. Have any questions, reach out to us. We're more than happy to help give you advice and hopefully put together an action plan to get you from where you are to where you want to go. Have a great day, everyone.